Hello, everyone. My name is Todd Rosenbluth, Head of ETF and Mutual Fund Research with CFRA, and I'd like to welcome you to today's webinar, How to Sort Through the Growing ETF Universe. Joining me today are two of my colleagues at CFRA, Angelo Zeno and Jim Corder. Angelo heads up our coverage of the semiconductor space, among other areas within the technology sector. Jim covers aerospace and defense companies, and more importantly for this webinar, we're going to talk about transportation stocks. Before we get started, I want to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we'll do our very best to answer as many of these questions as we can. Now let's talk about the agenda we're going to have here for this webinar. I'm going to walk through a reminder about who CFRA is, give you a state of the overall ETF industry and where the money's been going. Then I'm going to bring in my colleagues, Angelo and Jim, to talk about the semiconductor and transportation spaces within their coverage. And I'm going to come back on to help you sort through the ETF universe, looking at other ETFs outside of the industry space. And then at that time, we'll take your questions and other ones we received prior to this webinar. But we're really excited for you to join us as we kick things off. So let's now talk about who CFRA is and how we fit into the overall marketplace. So you probably are familiar that CFRA acquired the S&P Equity and Fund Research business in 2016, but obviously both our history at CFRA and then the history covering stocks back at S&P dates back many years. I won't walk you through the full timeline, but we've been around for more than 90 years focusing on the equity and fund research business as a true independent research provider. As we move forward now on the next slide to who we are today, you can see how we offer a proprietary research approach. We're going to spend most of the time talking about the sector and industry research and the ETF and mutual fund research that you'll see here within this stack. But you should know, obviously, we cover more than 1,500 stocks qualitatively on a global basis, more than 20,000 stocks on a quantitative basis. And we, as a broader team, also work within our investment strategy team, offering market commentary and offering differentiated idea generation. On the next slide here, you can better sense how you fit into this and the firm that you work for. So many of you are probably in the wealth management space, focusing, and that's the second half of that row, where you'll see wealth managers, online brokers, banks that we're working with. But we also have relationships strong in many cases with asset managers, hedge funds, mutual funds, law firms, you name it. We're offering our services to the broader investment community to help out with various investment strategies. And on the next slide here, the reason why we remain a trusted partner is our independence. We do not manage money. We do not make trades. All we do is research. And the views that Jim, Angelo, and myself are going to offer are our own and our firm's own, and there's no conflict behind what that is. We're not offering you anything other than our best and true ideas. Now, let's jump into the overall ETF industry. That's my area of focus. And as we move to the next slide here, just to give you a lay of the land of where the money has been going historically and where it's been going more recently. We're now up to over $3.7 trillion in assets. We're actually close to 3.8. Now, if you do some rounding here, as of the end of February, very strong year in 2018. You can see where the money flowed different from the broader perspective. Fixed income ETFs are very popular. We're not going to spend much time on fixed income ETFs, but we will in an upcoming webinar. But most importantly, you're seeing it across the board. As we looked at the month of February, equity ETFs were increasingly popular. About $15 trillion moved into equity ETFs, and we're going to spend most of the time talking about that. On the next slide here, you'll get a sense of where the money's going at an individual ETF level. We've listed the 5 most popular ETFs, 3 from iShares, 2 from Vanguard. You probably either have one of these in your portfolio or certainly are aware of them and considering it among your choices. We're going to spend a little bit more time on the emerging market slice of this, as well as the minimum volatility slice of this. But I would note that Vanguard, prior to us doing the webinar, but after putting the slides together, Vanguard cut VWO to 3 basis points. It is now the cheapest ETF offering S&P 500 index exposure, and we expect we're going to see more money flowing in to that product. As we move to the next slide here, the reason why we think that's going to happen is we're seeing a race towards the bottom of lower fee products. This slide references zero fee ETFs. So let's move there and then I'll come back up. We saw in February an updated filing for the first of 2 zero fee or no fee ETFs from a fintech firm, an online banking firm known as SoFi. SoFi is going to be offering growth-oriented ETFs tracking the selective indices. They're going to be waiving the fee until 2020, but we at CFRA believe you don't come out in the marketplace with a zero fee ETF to try to crash the ETF party. They're likely to continue to waive those fees for a number of years. Now, why would they look to do that? Well, investors are increasingly adopting low-cost products. 96% of net inflows in the fourth quarter went to ETFs that are charging 20 basis points or more. Cost remains the most popular metric in ETF selection, much to the disagreement that we at CFRA have. We think it should be important, but it shouldn't be the only reason in choosing ETFs, and we're going to spend a number of slides to try to make that case to you. But staying here for a moment on this prior slide, let's go back to the prior slide here. On a deep-pocketed firms really can bring the cost down. We saw Vanguard cut the fees on more than 10 ETFs. So again, we put this slide together when Vanguard initially cut ETFs. We're going to touch on some of them like VYM and VWO, but we touched on earlier that 3 basis points for Vanguard 500. We would certainly expect to see iShares that offers a 4 basis point S&P 500 product look to match that, and other firms that are competing more increasingly on price like Schwab, like JP Morgan, look to bring costs down even more. Now let's move here to the next slide. We set this up for a bit. For the E does not stand for easy in the ETF. It obviously stands for exchange. The easiest thing to do would be to buy the cheapest ETF, the best performing ETF, something that's now commission-free. We've seen Fidelity and Schwab expand their commission-free program. You really can do much better than buying the cheapest product. And we'll show you why in upcoming slides. We're a third-party partner. You're here for obvious reasons because you want to learn about the tools that CFRA offers. But of course, you have tools available on your platform as well. On the next slide here, we'll just refresh how we at CFRA analyze ETFs. We are looking at things from a more forward-oriented approach than Morningstar. We look at the underlying holdings. From a valuation and risk perspective, we've brought 2 of our star analysts here to highlight to you the value of looking inside and understanding the fundamentals and risk characteristics of the stocks within inside your portfolio. We touched on the importance of using and the priority of low cost, but we think that it's much more than the expense ratio. We use trading costs like the bid-ask spread as part of our analysis as well. Now, before I jump into bringing Angelo into this conversation, let's move to the next slide here to just set the stage for the sector ETF lineup and where it's really been going. The fourth quarter versus what we've seen early in the first quarter, we've seen a bit of a shift. We saw real estate go from net outflows to being strong net inflows. We've seen continued outflows for technology and industrials, although for industrials, it's a drop in the bucket compared to where it's been beforehand, and healthcare remains popular to be able to do that. So we're going to move on to the next slide here to just show you an example of 2 popular technology-oriented ETFs. You're probably quite familiar in the semiconductor space. There's a number of choices. SMH is the VanEck Vectors ETF. XSD is the Spider product, Spider S&P Semiconductor. As you can see, they have not performed in line with one another. While they both have gone down, or they both went down in 2018 and have both made money in 2019, there's a notable gap between this. Now, I would note that there's about a 10 basis point, I'm rounding here, 10 basis point difference in the fees for these products. Yet, obviously, you can see a bigger gap in out or underperformance with each of those. And so before I come and tell you more about that, I think it'd be insightful to hear from Angelo Zeno, who, as I mentioned, covers the semiconductor space, among other areas, for CFRA. Angelo, thanks for joining us.
Thanks, Todd, and hello to everybody on the call today. So I want to spend the next few minutes talking about our outlook on the semi industry, an area that has significantly underperformed relative to the broader market and major indices last year, but where we think investors should be looking to buy today. And why is that? We actually view the semiconductor industry today near a cyclical trough. We believe the fundamentals will bottom here, likely in the first quarter, early second quarter, with a sharp improvement expected in the second half of the year. In fact, for those counting, this would actually mark the fourth semiconductor downturn that we're experiencing since the 2009 recession low, and according to our estimates, would actually be the sharpest downturn that we're exiting since then. And we think that's actually an indication that the industry in the past has presented many great buying opportunities like the one today. What makes us believe that Q1 is a cyclical trough for the industry? A number of reasons. One, just pure seasonality. Typically, the semiconductor industry bottoms around the first quarter of the year. We expect this year to be no different, with orders starting to pick up with the likes of Apple, among others, starting in the second quarter of the year. Second, we think tariff concerns are starting to ease here. We actually saw a complete freeze in the fourth quarter within the industry as customers really kind of held off on any type of chip purchases given the uncertainty due to tariffs. Now that we're seeing some positive commentary on that front, customers, we think in January and into February here, are starting to kind of get back into the market and start purchasing a number of chips across the supply chain. And then I'd say three, memory demand. Memory makes up about 1/3 of the total industry demand for semiconductors. We actually see much more favorable supply conditions as we kind of exit here the first quarter of the year. We actually started seeing the improvement here in February across a number of memory chips. And as a result, we think that bodes well for a number of players going into the coming months. So that's really the cyclical story. From a secular perspective, it's really all about greater semiconductor content in areas like cars, factory automation, 5G related, data center growth, AI, which we think is an enormous opportunity in 2019 and beyond. And I'll go into some of those trends in the next couple of slides. And the final comment I will make here is related to M&A. It's been a very quiet on the M&A front here over the last year, largely because of the China-U.S. trade issues. But as a result, we do think a lot of those geopolitical issues start to ease here, and that gets a lot of chip makers back into the market and back to deal making. So going into the next slide. Like I said, the biggest problem child for the semiconductor industry over the last year has really been in the cyclical memory space. Prices have been tanking, which is typically a bad thing for many of the players in the space. The good news is the industry is very highly elastic. And given that we've seen about a 40% reduction in memory prices over the last several quarters, we think that will spur greater memory content in areas like smartphones, data centers, among other areas. And we also think that the good news is bloated inventories that we saw late last year coming down, setting up a nice recovery as seasonal trends start to improve. Like I previously stated, memory 1/3 of total chip sales, but its importance really can't be understated. And the reason I say that is because there are companies not only related to memory or the memory producers themselves, but chip equipment players, for instance, where memory orders comprise as much of 80% of company sales. A good example is Lam Research. And when we look at the chip equipment space, we currently have a less favorable neutral outlook compared to positive for semis. Overall, we continue to highlight that visibility and sustainability of the recovery in chip equipment names are a lot more uncertain, and that's why we prefer semis over chip equipment at the moment. The one comment other comment I will make on memory, we're starting to see some structural changes, we believe, with new players emerging out in China. China is looking to really prop up its local semiconductor industry there. It's been a huge focus for them, specifically related to memory. That bodes well for some of these chip equipment players in the near term. However, long term, it potentially hurts the dynamics of the overall industry and for memory providers like a Micron out there. Next slide here. So there are three enormous semiconductor opportunities we think that you can see here over the next kind of 2 to 3 years. The first one I'm going to start off with is the arrival of 5G being imminent. we think 5G, at least initially, will be the biggest positive within the mobile space, specifically related to the smartphone industry. For those that kind of are aware of what's going on with Apple, among others, smartphones today need to contend with very much longer replacement cycles and the maturation of the overall industry. But we expect 5G will help improve the replacement cycles, as a lot of early technology adopters will look to own a 5G device. So looking at both Samsung and Huawei in recent weeks, and they're the top two players in the industry in terms of shipments, both are looking to roll out 5G-enabled devices in 2019. But that being said, Apple more resistant, looking to hold off, we think, until the second half of 2020. We think that's actually a great move by Apple, and we know we're in the minority here. Reason being is we don't expect to see a nationwide network as it relates to 5G until late 2020 into 2021. So if Apple were to launch a 5G phone this year, we actually think demand would be tempered. So we actually think for Apple, it's a great move for them to wait into 2021 or late 2020. And you may not, or not, you may be able to see this from that chart over there, but we do expect about 1/3 of global smartphones to be sold by 2020 to be 5G enabled, with most of the demand coming from the high end of the market, and Apple's presence, of course, in 2020 really spurring the consumer appeal and the demand for 5G. So next slide here, automotive, we think, is the second major opportunity within semiconductors. You start thinking about automotive from a bigger perspective. It's really all about the electrification of the car and the emergence of autonomous growth, creating an explosion in just broader semiconductor content growth. So in fact, we expect content to grow at about a clip of about 8 to 10% here for semiconductors, even in a no growth environment for autos. So we're currently looking, I think, for a decline in autos here in 2019. Despite that, we do think that the content growth within semiconductors will allow for semiconductor growth related to autos to grow in a mid-single-digit pace this year. For those wondering, autos represent about 9% of total semiconductor demand. Semiconductor content today, I mean, you can think about where it's found within your car, but think about infotainment systems historically, but more so these days related to safety, powertrain, battery management, lighting, as well as futuristic is more autonomous features. Moving on to the next slide. So we believe that, essentially there's a major cloud war going on in the cloud as providers look to outdo each other by offering more extensive AI-powered services. So with data growth exploding at an annual pace of 30% plus today, companies, data scientists are craving a lot of AI-based services that can help them make sense of all the data that's out there and collected. In fact, it's believed that by 2021, half of all enterprises will employ some sort of AI to help improve productivity or manage risks, drive cost reduction. So given this, we think the top cloud providers, also known as the Super 7 out there, are really paving the way to adoption of AI in the cloud. So who are the Super 7? We keep telling people it's the big four in the US, Amazon, Microsoft, Google, and Facebook, and then you've got the three China-based companies out there being Alibaba, Baidu, and Tencent. They're really known as the Super 7 because they represent about 40 to 45% of all cloud spending out there. We think these cloud providers are going to continue to invest heavily in 2019 to really help create an infrastructure that's allowing organizations to use the public cloud for AI as an inexpensive way to kind of test different applications. So our view is in 2019, we're going to see about a 10 to 15% increase in investments from these companies. Companies out there within the semiconductor universe that will benefit the most, we think will include the likes of Intel, NVIDIA, AMD, and Xilinx. Moving on to the next slide here. So these are just some of our top recommendations within CFRA as it relates to semiconductors. For those interested on the semiconductor equipment side of things, our top buys include KLA-10 Core and Lam Research. If you're looking at more of a pure play memory play, that would include the likes of Western Digital, where we do have a strong buy recommendation your upgraded name earlier this year, as well as Pure Storage. Pure Storage being kind of an all-flash data center play, and we think they're very early in a major cyclical or secular upturn here that's going to take place here over the next 5 to 10 years as it relates to all-flash. Some of the smaller names out there that we think are very interesting: Mellanox, Monolithic Power, Diodes, Cyclical Semiconductor, and Semtech. Those are all names that we think not only have great secular opportunities, but we also think are potential M&A targets within the space. And then finally, when you start looking at some of the large cap plays out there with some of the secular drivers that we highlighted, whether it be 5G, whether it be autonomous cars, or AI, the names we like the most include Broadcom, Analog Devices, and Microchip. So that being it on my end, I'm going to pass it back to Todd.
Thanks, Angelo. Some great color about what's driving the overall semiconductor space. On my slide here, I want to just highlight again those two ETFs, SMH, which is the VanEck Vector Semiconductor ETF. It's more of a cap-weighted approach, or the largest companies are more dominant, and XSD is more of an equally weighted approach, includes more small and mid-cap companies. A couple of things that Angelo highlighted that I want to just drill back into. One, CFRA is more favorable on the semiconductor sub-industry than the semiconductor equipment sub-industry. You can see XSD, the entire portfolio, is in semis, whereas SMH has about 20% of its weighting within the semiconductor equipment space. The second thing is he talked about some M&A activity potentially in the small cap space and the appeal of that, but also highlighting a number of large cap companies. So on the right-hand side of this, you'll see Broadcom, the ticker is AVGO, and the weighting differential between these two products, as well as Marvell Technology, MRVL, and the weighting differences between them. You can clearly see a difference between that. It's also notable that what Angelo did not mention among his top picks were Intel and NVIDIA. Those, I believe, are both hold recommendations at CFRA. You have much more exposure to that within SMH as a cap-weighted approach to things. So again, it's important to understand what's inside the portfolio. That's going to drive performance in the past. It drove performance in the past. It's going to drive the future performance as we move forward. Now, on the next slide here, before I bring Jim Corridor into the conversation to talk about his area of coverage within the industrial sector, a play on words here: can the transport ETFs keep on trucking? Two popular ETFs, IYT is from iShares, XTN is from State Street. IYT was the better performer in 2018. It still is the more expensive of the two choices. IYT has underperformed XTN, but again, the gap between these two products is wider than the less than 10 basis point differential in fees. It's considerably larger than that. So a couple of things. One, you shouldn't just buy the cheapest product. You also shouldn't just buy the one that performed best in the past. You should have a better understanding of what's going on. And as we will come through, there's a number of sub-industries you get exposure through these transportation ETFs. And with that, Jim Corridor, let me bring you in. Jim, as I mentioned, covers transportation stocks within the industrial sector for CFRA. Thanks, Jim.
Thanks, Todd, and good morning, everybody. Yeah, so I'm going to talk about our views on the transportation space. There are actually 4 sub-industries within transportation, and we're going to talk about the 3 that we are most positive on, namely airlines, air freight and logistics, and railroads. We're going to leave trucking out for now because we are not positive on the space. So starting with airlines, we do have a positive fundamental outlook. We do think that demand remains strong for air travel, both business and leisure. We think that fares are on the rise for 2019. Airlines are very focused on this metric, getting fares higher, and we think they're having success on it. And we also see a tailwind to cost because we think oil prices have come down, likely to stay relatively low in 2019, which should mean that fuel costs are a little bit lower for them this year. The number one point for the industry, though, is yield, which is a proxy for fares and prices. Airlines have been very focused on this metric. This is what investors have been primarily concerned with. The stocks underperformed in 2018, and we are seeing some traction on this. Q4 unit revenues rose by 4.3% on average in our airline coverage universe, with Spirit seeing the most growth and American Airlines seeing the least growth, but all the carriers that we cover seeing some growth in unit revenues, which is a positive sign for the industry. Commentary around Q1 when airlines announced their fourth quarter results was positive. And yesterday, Delta Airlines reported their traffic numbers for February, and again, they said that unit revenues are looking good for the quarter as well. That stock is getting a boost today on that commentary. So we think that yield growth will be positive in Q1. We don't think that investors are fully anticipating this into their own theses on the sector. And as these numbers start to come in and reassure investors, we think the stocks will continue to do well. One of the main things that leads to good yield improvement is disciplined capacity growth. The industry has been focused on keeping capacity growth below GDP growth and keeping capacity growth at a level that will support fare increases. If you grow too fast, you have to put seats on sale. That degrades unit prices. And if you go too slow, you're missing out on potential revenue opportunities. So they need a balanced growth approach. And we think airlines have been very quick to cut capacity into any kind of weakness in demand rather than putting fares on sale. And that's a different kind of approach than they used to have in the boom and bust cycles of the last few decades. The stocks did underperform in 2018. We see valuations as very attractive because earnings have continued to grow while the prices have come down. The main reason, like we said already, yields are a concern and oil prices were a concern in 2018. Both of these things are flipping in the opposite direction in a positive way, we think. And also airlines have been very active on stock buybacks, which have meaningfully cut into share counts, which allows a lot of leverage for EPS from the growth that we're seeing in revenues. Maybe look to the next slide. This is a little proxy for what's going on in demand in the industry. You can see the orange bar is capacity, which is measured by available seat miles. The blue bar is the number of people flying measured by revenue passenger miles. And then the bar along the top is load factor, which is just one divided by the other, which shows how full planes are on average. So planes are full, people are flying, and that's going to allow for fare increases, we think. So that's the reason why we're mostly positive on the sector. And here are some picks. We're going to go through them one by one. This is our entire airline coverage universe here at CFRA, Alaska Air Group. We have a buy on the stock. We think that this carrier is much less seasonal than it's ever been in the past. It used to be primarily an Alaska flyer. So during the winter months, there was very little flying. Revenues were very concentrated in the second and third quarters. They have now expanded into Caribbean markets. They've expanded into Hawaii. They have some transcon flying now, so they're much less seasonable than they have been in the past. And the stock should do well this year on the demand trends that we're seeing. Allegiant Travel Company is a very small discount carrier that is a disruptor in the space, but we think they are growing way too fast. They haven't been able to get unit revenue growth up enough to offset the capacity growth that they're seeing. And we expect that trend to continue in 2019. We have a hold on the stock, even though we're very positive on the overall space. American Airlines Group is likely to see strong unit revenue growth this year, even though they didn't see so in Q4. Like I said, they were the weakest one in Q4 in terms of their growth, but we see improved trends in this year, higher business travel, better markets in some oil-producing places because oil production is on the rise, which is hurting pricing, of course, but is definitely leading to more travel by executives out in the oil states, and also just a better performance on unit revenues and operating margins into lower fuel costs. Delta Airlines is our top pick in the space. They are by far the best run airline, we think. They get the most business travelers. They have the highest unit revenues versus their peers. They're generating more cash, and they're using that cash in creative ways, investing in other airlines like Aeromexico and Virgin Airways, investments in an oil refinery, which they're unloading but they are taking shots at creative ways to use their cash because they have enough. JetBlue Airways, also a story where we think they are growing too fast and outpacing their potential revenue growth with too much capacity growth, so we have a hold there. Southwest, we think, is a very well-run airline. We've downgraded them to hold last week because we just felt that the issues that they're having with their mechanics is going to lead to a miss in Q1. Overall, we think that they have a great balance sheet. They have a well-run airline, but we're just worried about Q1 in terms of their overall revenue growth because of planes out of service because of the issues that they're currently having with their mechanics. Spirit is doing the best in terms of their unit revenue growth while also growing capacity the fastest in the industry. It's because of this, they're relatively small. I don't know if they can keep this growth up forever, but right now they are growing faster and getting the benefits of it on the unit revenue growth side as well. So we like that stock. And United Airlines is a buy. After horribly managing several aspects of their merger with Continental and having public relations nightmare after nightmare, they have seen a lot of improvement on both the merger integration side and on the PR side of the business. They are also improving sharply on their financial trends and closing the gap versus peers that way, which should allow them to close the gap versus peers on a valuation perspective as well into what we expect as the entire group seeing valuation expansion this year. So we have a buy there. Those are our picks in airlines. We're going to move on to air freight and logistics. We are positive here. The number one thing for air freight and logistics side of the business is e-commerce growth, driving volumes and pricing improvement for many different aspects of the industry. Online sales are well outpacing overall retail sales, and we expect that trend to continue in 2019. Look through the slide here. We have some numbers on what 2018 holiday sales were, well outpacing, with the e-commerce side of it, well outpacing overall holiday sales growth. Strong trends likely continue in 2019. 10% growth is decent growth for the online space and could do even better, we think. UPS and FedEx have both pushed through rate increases. They do so annually. We think they are going to get good traction on those increases because demand is so strong and the customers want them to prioritize their volume. So they will absorb a lot of these price increases without pushback. Things that support demand in e-commerce and overall volumes for parcels is strong U.S. GDP growth, good global GDP growth. Consumer confidence remains high. We think the environment is still ripe for strong consumer purchases of all kinds of different kinds of retail packages. These stocks did underperform in 2018. There were worries about cost and execution because the volume growth has been so strong for the past 2 years. Both UPS and FedEx have had to cope by making significant infrastructure investments. There was also some misses versus holiday expectations in the number of packages because they didn't have enough staffing in past years, so they've had to overstaff for 2018, which led to higher costs. You see the numbers here. Air freight and logistics did not do a good job in terms of the stock performance in 2018, but we think the valuations look compelling. Both UPS and FedEx had strong growth in earnings last year, and at the same time, their stock prices dropped sharply. Valuations look very well. They are well below their historical averages on both forward PE and EV to EBITDA bases, and we think the valuations look compelling. So moving to the next slide, this is a little proxy for what's going on in terms of overall demand. If you look at the little dip at the beginning of 2019 here, past November 2018, we think holiday sales overall were a miss. Although e-commerce growth was good, we think there's going to be a little bit less restocking in the first quarter. Also, the government shutdown did impact demand a little bit in the start of 2019. But overall, all these trend bars, which is domestic, international, and total air cargo volumes, are trending upward. And we think that should continue for 2019. Moving to the next slide, here are some of our picks in the space. We're going through them. C.H. Robinson is a relatively smaller third-party logistics company that doesn't own trucks, doesn't own planes, doesn't own ships, but is able to get volumes to wherever they need to go through using third-party contractors. However, they do have exposure to the produce sourcing space due to an acquisition that they made that we think was a bad move. That is dragging on overall business, so we have a hold there on the stock. FedEx and UPS are both strong buys. We think the e-commerce trends are strong enough to support both of these businesses for a long time to come. We think that trends are going to be strong again in 2019, and we think there's significant operating margin expansion potential this year after the infrastructure investments they've made over the past couple of years, which should allow for strong earnings growth, and the valuations look compelling. Look at Landstar. Landstar is a relatively smaller third-party logistics provider like C.H. Robinson without the exposure to the produce space. They do get a good contract with the U.S. Department of Disaster Relief. Whenever there's a hurricane or storm, that activity has increased, so they're getting a little bit of a revenue boost there. And we think they're a very well-run, consistent operator with strong revenue and earnings growth. And XPO Logistics is highly exposed to Amazon, and that's the reason why the stock underperformed over the past 6 to 8 months. We think that they'll get through that issue as we move through 2019. They are a consolidator in the space. They've been very acquisitive in rolling up different kinds of companies within trucking, within freight forwarding, logistics, and they have grown to be a behemoth in the space that many people haven't heard of. We think that the valuation looks compelling there as well. Now we're going to move on to railroads. We have a positive outlook on this space. We think commodity trends and operating expansion are the theses for 2019. Commodity growth is likely to be strong this year. thus far this year, we're starting out weak with total traffic up only 0.1%. Intermodal volumes are weak. Intermodal is a proxy for consumer spending, we think, and with the government shutdown and relatively weaker retail sales for the holiday season, again, weaker restocking, we think that's what's impacting Q1 in terms of intermodal volumes. But there is strength in oil, strength in grain, metals, and chemicals. So many of the commodity groups are seeing growth, and we do expect a rebound in intermodal as we move through 2019. 2018, we look at the traffic was up 3.4%, which is strong growth in traffic, and on top of that, there were pricing increases as well. For 2019, we think the story is operating margin expansion likely. Most rails are moving to change their operating models towards scheduled railroading from their old model where they would wait for a number of cars to accumulate on the rail before they would take off. Now they have a schedule. If you get your car there on time, good. If not, they'll take off without you. So what that does, it allows for faster train speeds. It allows for lower costs because you know where the trains are on the network, and you're able to get things to a place on time. You have staff in place to meet it. There's a lot of different operating metrics that improve as a result of scheduling railroad. CSX adopted it in 2017. Union Pacific and Kansas City Southern are looking to adopt it this year. Canadian Pacific and Canadian National were both pioneers in this model, and we think that you could see as much as 1,000 basis point improvements in your operating margins based on adopting this model, which is 10% operating margin expansion, and that's going to allow for strong EPS growth along the network. These stocks outperformed in 2018, largely on good commodity growth and also on operating margin expansion. We see the same trends in place for 2019. And with earnings growth outpacing the growth in stock appreciation, we think the valuations still look very attractive, even though there's been growth. Now we'll take a look at some of the stock picks. CSX Corp, like I said, they adopted scheduled railroading in 2017. They saw a huge improvement in their operating margins. It's led to earnings outperformance versus their peers and led to several quarters of beating street expectations on earnings numbers. We expect that trend to continue. Canadian National and Canadian Pacific are going to benefit from better trends in commodities in Canada versus overall North America. We see strong oil volumes this year over there as there's no fully formed pipeline to get oil from the tar sand fields out to refineries, so that has to go by rail. Kansas City Southern is a play on Mexico traffic. They have a huge cross-border business between both Canada, the U.S., and Mexico, and with the new treaty likely to be signed soon to replace NAFTA, we think that there's going to be some good opportunities there for them. And then the last two, Norfolk Southern and Union Pacific, they have been slower to adopt the move to scheduled railroading. So we think that their stocks are less likely to see outperformance this year. And that's pretty much it.
So we're going to stay here on the slide for a moment just because I want to be able to highlight the value of the research approach that CFRA has. We intentionally spent a good amount of time during an ETF webinar so you could hear from Angelo and Jim to understand their approach to analyzing their industry coverage, the way that CFRA looks at the world from a holdings-based approach. Our approach to analyzing ETFs is quite different than others that are out there in the marketplace. You know who they are. I won't name them specifically. We look inside the portfolio. We feel we've got that expertise to be able to do that, and I think hopefully you've gotten a great sense of that. As we move here to the next slide, let me just stay here on transportation for a moment. Jim talked about airlines, air freight, and railroads. You can see the difference between IYT, a reminder that's the iShares U.S. Transportation ETF, and XTN, the SPDR S&P Transportation ETF. And you can see IYT more exposure to railroads and air freight and logistics, but less exposure to airlines, obviously the inverse being the case. I think what drills this down is even if you are agreeing with Jim and being favorable on the air freight and logistics space, how to go about doing that is important. FedEx is obviously the 800-pound gorilla in that space. From a cap-weighted approach, which is what IYT does, it's 10% of the portfolio. CFRA's approach to analyzing ETFs is unique within the overall marketplace, and as such, our coverage of that continues and leverages the expertise from our equity research team. So sorting through the ETF universe, we're going to try to go through a number of case study examples here. And as we move through to the next slide here, just to remind you, we cover about 1,500 Equity and fixed income ETFs, we're leveraging, for the case of the 1,200 plus equity ETFs that we cover, we're leveraging the stock research team qualitatively and quantitatively that our team is offering across various sectors and industries, even if we're not talking about sector and industry-oriented ETFs. And so on the upcoming slide here, we'll start to go through some case study examples. We're going to talk about emerging market ETFs. In this case, I mentioned earlier VWO. The fee went from 14 basis points to 12 basis points and was announced last week. You can clearly see that is a difference between IEMG, the iShares Core MSCI Emerging Markets ETF, but the gap between those two products over the last 3 years was quite large. Almost 100 basis point differential between these two popular products. And again, the reason why that would be is when you come down to the underlying holdings. So as we move to the next slide here, we'll show you again the key difference between that at the index level is when you look at countries and individual stocks. So we've used this example in the past, but VWO, which is a Vanguard product, tracks a FTSE index. South Korea is not an emerging market country, is not classified that way for FTSE Russell, the way that it is for the MSCI-based product from iShares. So nearly a 15% weighting differential in whether it has South Korea or it doesn't. And of course, if you take a major country out, your exposure is going to be quite different. So more exposure to China and India. And we look at a stock level, you can wonder if South Korea matters. Well, Samsung is the second largest position within emerging market ETFs if South Korea is part of that, as it is with IEMG. There's no exposure to Samsung within the Vanguard, in this Vanguard product. There are in other Vanguard products, depending upon whether you're in a developed or an emerging market ETF. Let's move to the next slide here to talk about other examples of where it's important to look inside the portfolio. So let's just set the stage for a bit of where money flowed from a smart beta approach. We've seen a shift into, we've seen a focus more on lower volatility, lower volatility has been a popular place to invest in the beginning of 2019 as is quality, whereas dividend strategies, not as much. And so we're going to highlight, again, low volatility and dividend examples on the upcoming slide. So Vanguard, on the next slide here, we'll see that on Vanguard, cut the fee again for VYM. This is their high dividend yielding ETF. It used to be 8 basis points. It's now 6. That is cheaper than SPY-D, which is the S&P 500 dividend ETF offered by State Street. It's now cheaper. Again, the risk of sounding like I'm repeating myself, the performance gap is quite large. Again, almost 100 basis point differential between these two popular products. And the reason we get to that is when we look at the underlying exposure. On the next slide here, you'll see a focus of what industries and sectors we'll have exposure to. And real estate really stands out. So there's almost no exposure in VYM to real estate, whereas it's an 18% position for SPY-D. Simon Property is a perfect example of what matters when classification. You can see SPY-D has a weighting within for Simon Property, and it has an identical weighting roughly in ExxonMobil, but ExxonMobil, which is in the energy space, is more than a 3% position, so nearly a triple weighting within these two dividend ETFs. Not surprisingly, they're performing different from one another. On the next slide here, we'll talk about lower volatility ETFs and the difference between them. We mentioned earlier USMV was very popular. Actually, both these products were pretty popular to start the year. USMV has gathered more assets. It happens to be the cheaper ETF by 10 basis points versus SPLV. Invesco offers the SPLV product. iShares offers USMV. And you can see that the cheaper product has been the better performer in more recent periods of time. But again, it isn't just that fee differential. It really comes down to the exposure. And we'll do this last example on the next slide here of the differences of the exposure between these products. You can see a more growth tilt to USMV. from a sector perspective, that is, in that information technology is nearly triple the overall weighting within USMV versus SPLV, whereas the more defensive sectors like real estate and utilities are heavily weighted within SPLV and are more moderately sized in weighting versus in USMV. But at the stock level, I find this interesting as well. Paychex is a technology stock. You would think it would be a heavier weighting within the more tech-laden USMV product overall, but yet nonetheless, Paychex has a slightly lower weighting, and again, that's just the way that it's done from a rebalance perspective. On the next slide, and before we get to Q&A, just to show you, if you're not accessing the research that we at CFRA have on both an ETF perspective and a thematic perspective, or perhaps not even from a stock perspective, and are less familiar with Angelo and Jim's commentary, this is what you'd be finding. On the left side of the screen is a sample of our ETF research report, the triple Qs from Invesco. That is the focus ETF of the month for March for us. Triple Qs is going to turn 20 years old in the coming days, and we thought it was worth digging closer in on that. And you can find that research on our MarketScope Advisor platform. My content, as well as thematic content that Angelo, Jim, and our broader stock research team offers from a qualitative perspective. You can find the thematic research tab on MarketScope Advisor as well. And we'd encourage you, if you do not have access to the MarketScope Advisor platform, to let us know either by visiting CFRAresearch.com. You can submit a question on this platform, on the GoToWebinar platform, to be able to do that. And with that, I want to be able to start to take questions. Thanks, folks, for sending in so many questions that we've had thus far. We're going to get to as many as we can in the time remaining. So, Angelo, I want to just start with you for a moment we talked about a number of areas you're favorable on. Maybe you could just talk about, since CFRA is independent research, we have a number of unfavorable opinions within the semi space. Any areas you might avoid or that you think could underperform on a relative basis?
Yeah, so, when we kind of look at semis right now, I'd say the areas that got hit the hardest are probably the biggest opportunities as we sit here today with the most upside, right? So if we were to see the cyclical recovery continue onwards, the areas that we would think would see the most upside include memory, and our top buy within there is Western Digital, ticker is WDC, and along with a number of the chip equipment plays, specifically Lam Research, which already has had an absolute monster run here thus far in 2019. When another area that has also been hit very hard within semiconductors has been what I call the China industrial market. Probably got hit the most in the fourth quarter, and names related to kind of industrial automotive plays and highly tied to China, we think are great opportunities. A name like ON Semiconductor, ticker ON, Cypress Semiconductor, CY ticker, among a host of others, we think are probably the two best areas to play on a recovery right now. I'd say the area we're probably most concerned about in the immediate near term is data centers. Data centers probably have the most growth upside here over the next couple of years, but remains the biggest risk factor from a consensus estimate perspective. We think the consensus estimates could be a bit too elevated as we kind of see this hockey stick reaction in the second half of the year. The names I'd say I'm most concerned about probably are some of the larger names like Intel, AMD, NVIDIA. We actually downgraded both Intel and AMD recently, as we just think there are better plays within semiconductors right now over the next couple of weeks and months. But that being said, those remain very great stories. They're just names that we would rather play here over the next couple of months.
Thanks, Angelo. I'm going to take a question that came in, actually combine a couple of questions that came in for myself on the ETF front before I bring one to Jim in a moment. We got asked about just are all ETFs index-based, and then separately got asked about ARK Innovation ETF. The ticker on that is ARKK. So let me do the first part of that of not all ETFs are index-based. There's a number of actively managed ETFs. 2018 actively managed fixed income ETFs like Mint, M-I-N-T, and JPST from JP Morgan. The latter one were very popular, short-term bond products. We've seen growing interest in actively managed equity ETFs. ARK's products would certainly fit that bill. They're performing well. We have an underweight recommendation or ranking on ARKK. That's primarily coming from two aspects. One, when you're paying for active management, you often will pay a higher fee. In this case, the ARK products are at a premium fee, and that's something to be mindful of. The second thing is at the holdings level. So we do our research, as you know, looking at the underlying stocks. Tesla is the largest holding within this portfolio. It's north of 8%. I believe Tesla is a sell-recommended stock at CFRA. I mentioned earlier, NVIDIA is a hold-recommended stock. That's a top 10 position. Stratasys is another hold-recommended stock. So from a holdings perspective, we respectfully disagree with the valuation opportunities of this. But obviously, we are having one view. There's other views within the marketplace. Jim, I want to bring you into this. There was a question about JetBlue. I believe since we started prepping for this webinar, JetBlue reported some numbers. Maybe you can comment on that and the overall view on JetBlue again.
Yeah, so the airlines are all presenting at a conference this week, and it seems that JetBlue has said that their revenue numbers are going to be a little bit weaker than expected, but they're going to make their earnings numbers because of lower costs. We still have a hold on the stock. We think that obviously the entire airline space is likely to see stronger demand this year as our main thesis, with lower costs because of lower oil prices. What JetBlue is trying to do is they're trying to grow faster than we think is wise, which is why we don't have a buy on the stock. But also, when you do grow capacity at a rapid rate, what you do is you leverage your costs over a higher number of seat miles. So that leads to a better cost performance than maybe most of the street is expecting. So they can get some cost benefits from capacity growth. And I think that that's what they're trying to do right now. We think that strategy will not allow them to close the gap versus peers, both on a financial basis and on a valuation perspective. So we're not positive on the stock on that news.
So thanks, Jim. I'd add in here that we just got a question about an ETF that trades under the ticker or JETS, which is an airline-focused oriented ETF, and our view on that and whether our view in relation. I would obviously point out that an airline-oriented ETF is almost entirely, in this case, exposed to this sub-industry, and thus doesn't get the benefits of diversification into the air freight and logistics trends that Jim talked about, the railroads trends that you find from IYT and XTN.
Yeah, so let me interject there, because if you are exposed more to airlines than the other space, airlines do trade at much lower valuations than other kinds of transportation companies. Logistics companies trade at forward PEs in the 17 to 18 times. Airlines trade at the 9 to 11 time forward earnings. So that would be a reason why JETS would appear to have a cheaper valuation.
So thanks, Jim. And I'll take one. Apologies for reading off the screen here about our take on EEMV, which is an iShares emerging market minimum volatility ETF, and understanding our take on that. So we have a market weight rating on that respective ETF. So this ETF combines a couple of the themes we talked about. We talked about emerging markets, and we talked about low and minimum volatility. And so this is the emerging market version of USMV. And so it's going to invest in the least risky stocks, or among the least risky stocks, depending upon its geography and respective of the sector. So it has less exposure to China, for example, and more exposure to Thailand versus broader emerging market ETFs. So you'd obviously, there's more than two choices within the emerging market space. You can choose to have a lower risk approach to emerging markets, EEMV, and an Invesco product, EELV, are two other choices that are out there in the marketplace. And thus, you want to be able to sort through that universe. The tools that we have on our Market Scope Advisor can be able to do that. And with that, I appreciate all the questions that we got. I appreciate how you folks stayed with us as we struggled with some technical difficulties, but thanks for doing so. We're back. We've enjoyed the Q&A session. And as I wrap up the Q&A session, I want to mention our next webinar, which is coming up on March 14th. Jim is going to be part of that as well. We didn't talk about the role of Amazon and how it is impacting the logistics space, but it certainly is a topic I'm sure that's going to come up as to how that impacts FedEx and UPS and the other air freight and logistics companies. We're obviously going to talk about Amazon as well, which we at CFRA cover, and other retail companies from within. So a link to register for this session will be sent to you later on this afternoon, as well as a replay of today's session. Now, on the next slide here, just to thank you and to show you again our faces, within the next day, you'll receive a note from us with a link to also not only the replay, but the slides. For those of you that subscribe to MarketScope Advisor, you'll find the research that Jim, Angelo, and I were talking about. If you don't have access to MarketScope Advisor, or you don't have access to the ETF tab of MarketScope Advisor, where some of the commentary that I talked about could be found, visit our website at cfraresearch.com or contact us at cservices@cfraresearch.com, and our phone number is there up on the screen as well. And if you stay with us, there'll be a survey that'll be popping up. Please be nice to us, but be honest with your opinion, and we've enjoyed having the conversation with you. Have a great day.